Hello everyone, welcome back. So in this video, we will learn one of the most important lesson of financial accounts or BBA or maybe business all over the world, which is very important lesson. It is debit and credit. Finally, you will learn this. What is debit and credit? So let's start it. So the first one is, what is debit and what's credit? It has two main or two common different. The first one is debit. Also, every single time it write on the left side of transaction, maybe any books, but credit write on the right side. So after that, what's the second difference between them? The second one is debit. Like the definition is it's a Latin verb deber, which mean positive effect on organization or maybe on you, and credit is credere, is a Latin verb which mean negative effect on you or your organization. So there are two signs which are they are so important, and increase and decrease. So after that, we will learn about business entity. And what's business entity? It has two reasons. What's like two definition. The first one is businessman and business are two separated person. The first one is business. Business is not a real person, it's an artificial person, but businessman is a real person. So the next one is second one, we record the transaction related to business, not the businessman. So the rules of debit and credit. The rules, the first rule of debit and credit. So asset equal, when asset increased, the effect is positive because we get a lot of money. So that's when asset become increased, the effect would be positive and equals to debit. Asset, when it became decreased, our money gone, our money spent, that has negative effect on us, so that's became credit. Liability, when liability increased, it has negative effect and it became credit. Liability when decreased, yes, it has positive effect because our liability became later, and claim of other person on asset of organization became less. So it has positive effect on business and it became debit. Rules of credit and debit on revenue. So in revenue, when decreased, we get a lot of loss. So what's loss equals to capital, and capital, when capital less, our liability became less, internal liability became less or became decrease, and it has positive effect, it became debit. So the next one is revenue, when it increased, it has profit, it has profit not for you, for the owner. So when owner get the benefits, his capital became also good and also up, and he will get a lot of profit. So internal liability also become high and liability also become high. That's why it's equal for negative effect and equal to credit. So the next one is on capital. A capital equals, when it increased, the claim of owner on asset of organization became increased, internal liability became increased, liability also became increased. So that negative effect on us, on business, and it became credit. So the next one is capital, when it decreased. So when it decreased, internal liability also became decreased, claim of owner on asset of organization became less, internal liability became less, liability became less. It has positive effect. When it has positive effect, it is equal and debit. Rules of debit and credit on expense. So in when expense became increased, its loss became equal capital. Claim of owner ownership organization became less. Internal liability became less. Liability became less. It has positive effect and became debit. So the next one is credit. Credit rules for expense. Expense became decrease. Profit. We will get profit. Our profit will be on our capital or for its owner. And internal liability became high. Liability became high, and claim of one or ownership of organization became high, and it has negative effect, and it's called or equal to credit. And thanks from every of you, every single person. Thank you so much that you watch videos until now, which I hope you enjoyed my lesson. So if you have any question, if you have any problem, comment below and I will answer it, inshallah. So make sure you subscribe and turn on notification so you'll never ever miss the next video. See you.